Hello, everyone, and thank you for joining us today for the first webinar of our Summer Student Debt Workshop Series, Student Debt Cancellation and Federal Loan Information. Before we begin, we're going to start off with some important notes about today's webinar. Next slide. All right, there we go. This webinar is being recorded so we can share the information today with as many folks who registered. So after today's webinar, anyone who registered for the workshop will be getting this recording in a follow-up email. If you have questions, feel free to go ahead and use the Zoom Q&A feature that's at the bottom of your screen. We will also be answering questions live towards the end of the webinar today and collecting all the questions so that we can follow up with as many of you as we possibly can after today. And things are ever changing around student loans, as we all know. So please note that the information shared today is accurate as of today and this moment. And also, we are not lawyers or financial advisors. We are policy experts and borrowers helping borrowers, along with the expertise of our State Department panelists today as well. And with that, many of you are most likely tuning in from the Los Angeles area, thanks to our partner and likely your state assembly representative. So first, we'll start with a quick message from Assemblymember Blanca Pacheco, representing Assembly District 64.
Hello and welcome, everyone. I am your Assembly Member, Blanca Pacheco, and I want to welcome you all to our webinar today on student debt collection and federal loan information. I represent over 500,000 residents within the 64th district. I represent the cities of Val, Cudahy, Bell Gardens, Downey, Norwalk, Santa Fe Springs, La Mirada, La Habra, and unincorporated South Whittier. I am excited today to have this opportunity to speak on the importance of debt collections and be an advocate for student borrowers, emphasizing that education is supposed to empower us, not weigh us down. Across California, more than 3.9 million borrowers owe nearly 148 million in student loan debt, and institutional debts have ballooned, affecting more than 750,000 low-income students. Institutional debt is defined by debt owed by students directly to their schools. To alleviate the more than 390 million in debt owed to California public colleges, I have introduced Assembly Bill 1160, which would prohibit institutions of higher education from barring a student from registering for courses or re-enrolling in a program simply because a student owes an institutional debt. It will prohibit institutions of higher education from withholding a degree or certificate that has been earned by a student simply because the student owes an institutional debt. It will prohibit the placement of institutional debts with for-profit third-party debt collectors, as well as prohibit the use of the interagency intercept collection program operated by the California Franchise Tax Board. AB 1160 aims to protect students from the most harmful of institutional debt and provide much needed transparency on the growth and implications of this debt across our state by requiring colleges and universities across California to obtain and publicly report on the growth of institutional debts, provide transparency for the most commonly used collection practices and their impacts on students. I am happy to be partnered with NextGen and the Campaign for California Borrowers' Rights Coalition on Assembly Bill 1160. I want to thank NextGen Policy, the Campaign for California Borrowers' Rights Coalition, and DFPI for today's important webinar. Lastly, I want to remind you, the students, that the numbers on your loan statements do not define you. Your worth is not measured by the dollars that you owe. Your dreams, aspirations, and potential are boundless. No debt can diminish your true value. So I want to thank you all for participating today. I am forever your advocate. I am your Assembly Member, Blanca Pacheco. Thank you, everyone.
All right, thanks again to Assemblymember Pacheco for helping make today's webinar possible and her leadership to protect student borrowers in California. My name is Samantha Sang. I'm the Legislative Director and Policy Advisor at NextGen Policy, or NextGen California, and we're one of the 5 organizations that leads the Campaign for California Borrowers' Rights Coalition, helping to put on this workshop series. The coalition is composed of diverse organizations working to ensure student borrowers see a future free of debt. So with us today, you'll also hear from coalition partners Cody Hunanian from Student Debt Crisis Center. And also making today's webinar possible, I'm happy to introduce now Selena Damian, our very own and first California Student Loan Servicing Ombudsperson at our state's Department of Financial Protection and Innovation, or DFPI. Selena, passing it off to you now.
Thank you, Sam. Good afternoon, everyone. Thank you for joining us today. The information that we are providing today is really important, really timely, and I'm happy to have everyone join us. This is a great group of advocates, of experts, and so we will get started. First, a little bit about DFPI. As Samantha mentioned, I am Selena Damian, the Student Loan Ombudsperson here at California's Consumer Protection Agency. Our role as the Consumer Protection Agency in the state is to regulate companies of financial products to ensure compliance, and this includes student loan servicers. We accept and review consumer complaints against these financial service providers. We take legal action when companies are not in compliance. We protect consumers from fraud and abuse, and we conduct education and outreach such as this one to educate consumers. In the student loan space, we conduct education on student loans, student loan literacy, credit building, and on protecting yourself from scams and frauds. Next, please. As Assemblymember Pacheco mentioned, in California, there are 4 million borrowers that owe $141 billion of student loan debt. California has the highest number of enrolled college students at almost 3 million. And in 2019-2020, prior to the pandemic, 46% of California college graduates had student loan debt, with the average borrower's debt at $37,000. In the United States, borrowers owe 1.75 trillion, and I believe that just went up to 1.8 trillion of student loan debt, the majority of that being federal student loan debt. Next, please. So in addition to that substantial amount of debt, we also know that student loan debt has a disproportionate outsized impact to students of color. Over half, or 56% of the students who attend public 2- and 4-year institutions in California come from low-income families that earn $40,000 or under annually. 90% of Black and 72% of Latinx students take out college loans in comparison to 66% of white borrowers. And we know that Black women have the largest student debt burdens of all. A borrower in a 75% minority neighborhood is 5 times more likely to fall behind on their student loan payments. And default rates are higher for Black borrowers, Latinx borrowers, and first-generation students. Therefore, it is very, very important that we educate ourselves and we understand student loans before we take them out. We understand how to repay the student loans in a timely manner so we can avoid some of this impact after graduation. Next, please. In California, in addition to the rights that are afforded to borrowers on the federal level through the Higher Education Act, in 2020, California passed the Student Borrower Bill of Rights, or Assembly Bill 367. This was a law that was established to strengthen the oversight of student loan servicers and to protect borrowers. And what this law does is it prohibits servicers from engaging in abusive, unfair, or deceptive practices and requires that they work in the best financial interest of borrowers, which they have not always done. Servicers must provide borrowers with the information and applications for the income-driven repayment plans, or the IDR plans, and other forms for federal benefits and protections, for PSLF forms, borrower discharge forms, or any other forms that a borrower needs. It establishes special protections for military borrowers, those working in public service, older borrowers, and borrowers with disability. It protects borrowers from any negative consequences stemming from a sale, assignment, transfer, system conversion, or payment made by the borrower to the original student loan servicer. And this is going to be highly important right now with the start of repayment and all the transfers that took place. A borrower can file a complaint through our agency, through our complaint portal, or through a paper application, but we will accept complaints against servicers if they are acting unlawfully. And again, California is only one of 13 states that has this legislation. And in addition to these requirements, it created my position as well to help advocate and help borrowers. Next, please. And before we get started on all the updates, just want to give some brief key terms so that you will understand what we are referring to throughout the webinar. Federal loans and private loans, the difference between those: federal loans are made and funded directly by the U.S. Department of Education through the William D. Ford Federal Direct Loan Program. The interest rates are fixed and they're set by Congress. No credit check are required, except for PLUS loans, and these loans can be subsidized and unsubsidized, or unsubsidized. All the information that we are providing today, the programs that we are going to be talking about, are for federal loans. Students may also carry private loans. These are loans that are made by lenders such as banks, credit unions, state agencies, or your school. They don't offer the flexible repayment terms and forgiveness options provided by federal loans. They often require an established credit record or a cosigner, and they may have higher limits. A borrower is able to refinance their federal loan into a private loan, but once they are refinanced into private loans, they cannot convert back to a federal loan. So that's really something really important to keep in mind. You've heard me talking about servicers. So the difference between a lender and a servicer: your lender is the company or the organization lending you the money. They originate the loan. For the federal loans, Department of Education is the lender. They contract with student loan servicers. These are companies that track the loans while the borrower is in school. They send the bill each month, collect and process payments. Any documentation related to your loan will be processed through the server. They are essentially the borrower's main point of contact. A borrower can be transferred to several servicers throughout the life of the loan. So it's very important. Can't stress this enough, the importance of knowing your student loan servicer, who they are. And we're talking about your federal loans. Next, please. And this here just shows some of the current federal loan servicers. We're talking about your Mohila, your Nelnet, Aidvantage, Ed Financial. And then you have your private lenders such as Navient, Wells Fargo, Sallie Mae, SoFi, Discover, and so on and so forth. So now that you have those basics, some information about your rights, I will hand it over to Cody to kick us off on the updates. Thank you.
Awesome. Thank you so much, Selena. And so great to have you and a powerful advocate at the state level to help protect borrowers and to educate and inform them. I have the great privilege of sharing all of the updates in the student loan space with our attendees today, which is, in the hundreds. So I'm thrilled. There's a lot to share. So I'm going to provide, I think, an overview of some complicated topics. We will try to distill them the best we can. And as a reminder, we have this Q&A window in the Zoom platform where you can ask your questions. So you definitely want to be sure to respond to questions that come out of all of this information. So as far as updates, we should start with, I think, the thing that is the most visible and has garnered the most attention, which is the President's student debt cancellation plan. I'm here because I'm an advocate for borrowers, and after years of sharing why student debt is a crisis, we were thrilled in August of 2022 when President Biden announced his plan to cancel student loan debt in response to the COVID-19 pandemic. The president has this authority in a law called the HEROES Act, which allows him to provide student debt relief in response to a national emergency. And we all know the pandemic was a really urgent emergency across the entire country. The way this plan would have worked is debt relief would be available to individuals with federally held student loans. Selena mentioned the difference between federal and private student loans. You know, so much of what we're going to talk about today is about federal student loans because those programs for relief and affordable repayments are clearly written into law. So this plan was going to apply to folks with federal student loans that earned less than $125,000 per year or $250,000 as a household for a married couple. The plan would provide up to $10,000 in student debt relief to anyone who qualified for this plan and up to $20,000 for those who have received a Pell Grant. The thought being that if you received a Pell Grant to pay for education, you come from a lower income, lower wealth background, you're more likely to struggle with your student loan debt, and this additional relief would provide a level of equity. 26 million people applied for this plan, and 16 million people had their application approved. Nobody had their debt canceled, but the application process was well on its way. And unfortunately, several lawsuits that blocked this plan made their way through the Supreme Court. And in June of this year, the Supreme Court blocked this initial plan. It's really important, though, that we be clear about what the Supreme Court ruled on, which was that this one specific plan and the use of HEROES Act to initiate this plan was blocked. But this ruling did not impact any other programs that already exist. And it left on the table the opportunity for the president to explore additional relief using other legal authorities. Next slide, please. So with that in mind, immediately following the Supreme Court ruling, the president announced that he is going to pursue student debt cancellation using an alternative legal authority in another law called the Higher Education Act. And the Higher Education Act actually allows the president to go much further with debt cancellation efforts than the smaller, more narrow emergency powers. To do this, there is now the requirement that that this administration pursue what is called negotiated rulemaking, or NEGREG, which has already started. And this is a process in which the public and stakeholders get to share their comments with federal officials. There is a negotiating period, and a final rule will be produced to propose a new student debt cancellation plan. This process is going to take some time. It's likely not going to finalize until sometime next year. So this has started. We should keep an eye on it, but there's no updates to share yet. And also keep in mind, this administration is also pursuing all sorts of other targeted debt cancellation for specific groups, including those who have been in income-driven repayment plans for years, those who've been defrauded by for-profit colleges, and there's been other reforms for disabled borrowers, veterans, and others. So the possibility for relief for borrowers is growing as these plans are being introduced and reforms are being passed. Next slide. So that gets debt cancellation out of the way. I know so many of those who are listening today, including myself, want to see that happen. But that is now going through an extended process, and we will keep an eye on that for this year. What borrowers really need to know when it comes to updates are things that are happening right now. So let's start with something that's really important. Federally held student loans have had their payments paused since March of 2020 when the pandemic began. During this pandemic relief period, interest was also paused. This relief is now set to end on August 31st. On September 1st, interest will begin to accrue again on federally held student loan accounts, and payments will resume starting October 1st. Now, I've spoken to thousands of borrowers since the pandemic began, and I know many people on today's workshop aren't financially secure enough to restart payments, whether it's the lingering effects of the pandemic or it's inflation or whatnot. this payment pause ending is going to be really challenging. So in response to that, this administration has also introduced what is called the on-ramp. And the on-ramp is going to provide borrowers a 12-month period in which they can miss payments if they cannot afford their student loan payments without falling into delinquency, defaulting on their student loans, or having the negative credit reports submitted for falling behind on their payments. Now, during this 12-month period, interest will continue to accrue and monthly payments in the future will be adjusted accordingly. So it's not completely a payment pause the way that pandemic relief was, but it allows those who cannot afford their loans to skip loans they cannot afford during this period and not face the financial consequences that typically come with falling behind on your student loans. Next slide. Now, another update that's come up that's really important, particularly for the most vulnerable borrowers. There is a program called the Fresh Start Program, which is a one-time opportunity for folks that have recently defaulted on their student loans to return their loans to up to date, to current status, meaning they will no longer be in student loan default. Along with this fresh start period, folks will have the default removed from their credit report. They will be able to access federal student aid again. So if they need to complete their education, they could do so. Debt collection practices will stop. And some folks who are accessing other government loans will be able to do so. So essentially, this will wipe the slate clean with regard to default for those who have recently fallen into default. Again, the purpose being that so many folks have faced economic harm and distress and setbacks during the pandemic, that we should provide an opportunity for them to get their feet back on the ground. Now, to apply for this, you have to contact your loan holder. If your loans are federally held, meaning the Department of Education owns those loans, you can contact the Department of Education either online by going to myeddebt.ed.gov. You can call the Department of Ed at 1-800-621-3115. And you can also mail them. You can write to P.O. Box 5609, Greenville, Texas, 75403. If your loans are held by a guarantee agency, this would be essentially for folks who have older FFEL loans or have been defaulted and their loans have been transferred, you'll need to call that guarantee agency directly. Next slide. So we've talked about the payment pause ending. We've talked about the programs that are designed to help people who cannot afford their student loan payments and those who have already defaulted. Now I want to talk about probably one of the most powerful updates that has come up recently. And that is a new income-driven repayment plan. Now, income-driven repayment plans are always valuable for folks who are going to face long-term difficulty affording their student loan payments. What an income-driven repayment plan does is lower your monthly payments based on your income. So this new SAVE plan, Saving on a Valuable Education Plan, is the newest repayment plan that the government is going to provide. And it has some really powerful reforms that I want to talk about. So let's just go over the details here. First, SAVE is a new IDR plan, and this will replace the most current previous plan, the revised pay-as-you-earn plan. The SAVE plan raises the amount of income that is considered non-discretionary to 225% of the federal poverty level. That means that if you make under 225% of the federal poverty level for your family size and your location, you will have a $0 monthly payment. Everything above that threshold will be calculated to adjust your payment accordingly. borrowers who are enrolled in the SAVE plan will also not be charged unpaid monthly interest. So in the past, if you were in an income-driven repayment plan, you had a very low monthly payment. If you were not covering the interest that accrued, that interest would add in your account, and it could be added to your principal balance, which meant that some folks who were enrolled in these programs saw their loan balances grow over time, and it led to this feeling that they were never going to be able to get out from under their debt. So some of this plan is launching immediately. What is going to launch next summer are some additional benefits. So one, if you have an undergraduate loan, the plan will cut the amount borrowers have to pay each month from 10% to 5% of their discretionary income. So remember, your discretionary income is every dollar you make above 225% of the federal poverty level. You used to have to pay 10% of that discretionary income. Your payments are cut in half essentially at 5%. If you have undergraduate and graduate loans, this plan is going to be a little less beneficial to you. What's going to happen is your monthly payments will be calculated as a weighted average between 5 and 10% based on the balances of those two types of loans. And this is really powerful as well. For those who have original loan balances less than $12,000, any remaining debt that you have will be forgiven after 10 years of payments in this plan. The thinking here, after years of research, it has shown that borrowers with the lower balances tend to be folks who could not complete their program, who are in the most financial distress, and are the least likely to be able to afford paying back their student loans. And so this plan says, you know what, for those low balance borrowers, let's erase this debt and let them move on with their lives so they can try to thrive instead of being weighed down by student debt. So because the SAVE plan is replacing the repay plan, if you are already enrolled in repay, or if you sign up for repay right now, you will automatically be enrolled in the SAVE plan. And anyone who enrolls in the future will have the opportunity to choose the SAVE plan amongst a variety of other plans. Next slide. So that is a really important update for those that are thinking about addressing their future payments, especially as the payment pause comes to an end here. There are also updates that are designed right now to address broken parts of the system that have harmed borrowers for years. One of those reforms is something called the one-time account adjustment. The one-time account adjustment essentially is designed to allow folks who should have completed an income-driven repayment plan or public service loan forgiveness, which is either a 20 or 25-year track or a 10-year track for public service loan forgiveness, but was derailed along the way because they were placed in the wrong repayment plan. What would happen in the past is a borrower would call their servicer. This would be someone who was struggling with their monthly payments. They could have been put into an income-driven repayment plan, which would have allowed them to make progress towards the 20 or 25 years needed to complete that plan, or make progress towards public service loan forgiveness. And instead, they were put in forbearance, deferment, or some other program that exists that didn't provide credit towards these tracks. This adjustment is saying that doesn't matter anymore. If you've been paying for 20 or 25 years, or you've been paying for 10 years and you qualify for public service loan forgiveness, we are going to erase your debt. So this adjustment is going to happen automatically for borrowers who qualify. It's going to happen behind the scenes a bit. This will happen for anyone that has a federal direct loan or an older federal family education loan. And the account adjustment will count towards forgiveness for any month you're in repayment, regardless of the payment made or the loan type or the repayment plan, as I discussed. Any time spent in forbearance, if that time was 12 or more months consecutively or 36 months cumulatively, will now count. Months spent in economic hardship or military deferment will count. Months spent in deferment prior to 2013 also will count. So you can see there's a myriad of different kind of scenarios in which borrowers will gain credit towards completing an income-driven repayment plan or a public service loan forgiveness plan. Now, the one thing I want to flag is this: 800,000 people have already been approved to have their student loans forgiven under this adjustment, because 800,000 people have already been in repayment for 20 or 25 years or qualify for PSLF, but were derailed. There's another group of borrowers who are going to be closer to completing these programs, but aren't at the end point. Those people are going to have their accounts adjusted over the next year. Unfortunately, we were hit on Friday with a lawsuit that was filed that is attempting to block this effort. So it is unclear what will be happening in the near future, and we should all be watching this lawsuit as it works its way through the courts. But keep in mind, anyone can take a lawsuit to court and try to gum up these programs. So we really don't know what will happen. But this program has huge potential, and we really look forward to defending it vigorously. And on this next slide, I'm going to pass it off to Samantha Sang at NextGen to share a little bit more about what's happening both at the federal level and at the state level. So Sam, take it away.
Thanks, Cody. Thank you for sharing a lot of those important updates. And so what you're seeing on this slide is really just a brief summary of some of those updates as we start to talk about what borrowers need to take actions coming up in the next couple of weeks as your payments will be restarting. So again, just since March 2020, we have all seen that pause on payments, including 0% interest rates. Unfortunately, starting in just under 3 weeks from today, on September 1st, interest rates will resume and borrowers will need to start making payments again this October. And so Cody just went over in detail about the Save and On-Ramp programs, but again, just posting them here to keep in mind as these programs can be of help as payments resume. So next slide, please. Since the payments were paused back in March 2020, as you've heard, there's been a lot of changes to student loan programs themselves, but also to the student loan servicing industry as well. So that means that your student loan servicer might have changed in the last couple of years. So it's really important that you know which company is your current student loan servicer and get in contact with them to make sure that they have your most up-to-date contact information. And as Selena went over, it's important to take the time to know your loan information, especially if you've had personal circumstance changes or the student loan servicer changes. You'll want to know exactly what your loan types are, your balances, and again, who your servicer is. Also take the time to review your account or accounts to ensure your servicer and contact information is updated. And for your federal loans, you need to make sure your contact information is updated on the studentaid.gov website. Be sure to carefully review all communications from your servicer or the Department of Education, especially in the mail. And in just a minute, Selena is going to go over some help for you to identify when you might be getting information from scammers. But for your federal loans, there are also different repayment options out there for you. Cody went over a few, and you can explore them through a loan simulator that the Department of Education has currently up on their website. So that's the link there on the slide here. And if you're also in default or expect to be once payments resume, there is the Fresh Start program that Cody reviewed that will help you get back on good standing by contacting your loan holder. And so we hope the information that we are providing here today will especially help any new borrowers Those are folks who have graduated during the payment pause and are new to repayments. This will be their first time, and anyone in default prior to the pause as well, as we know that things could be even more complicated right now for especially these borrowers. So with that, Selena, I'm passing it back to you so we can go over some tips around some fraud or scammers.
I'm on mute. Thank you, Sam. Thank you for that great information. As she stated, you want to be on top of all your communications, anything from your servicer and Department of Ed. However, with everything going on and on the news and all these updates, scammers are taking advantage of this, and they are contacting borrowers by phone, through emails, and mail. And they are offering services. So they are offering a loan forgiveness. They're offering to enroll you in repayment plans. They are pressuring borrowers, saying that this is a one-time opportunity, don't miss out. They're taking advantage of borrowers' confusion. I get emails almost daily from borrowers asking if these are legit companies. We want everyone to be very careful. Even in the mail, when they're sending correspondence, some of their logos look official. Read the fine print at the bottom these letters or applications. It'll say we are not affiliated with Department of Education, Department of Ed, or your servicers. They don't have time to call you multiple times a day from different numbers. They can barely answer their own phones, so they will not be reaching out. It's very important to understand that there's nothing that these companies can do for you that you can't do on your own for free. So all these applications, whether it's a PSLF application, switching over to another IDR plan, getting on forbearance, if you need to, any action that you need to take can be done through your servicer. Make sure you are dealing with a reliable company. Verify the information and research the company. It's very easy to just Google these companies. Many times these companies do sound official. They'll have student loan assistance in the name, or something that just sounds very official. So we want everyone to be careful, because what they're doing is they're having borrowers sign up to a subscription service, pay a large amount in 3 installments, and then guaranteeing some kind of forgiveness, or when in fact all they're doing is they're going to take your information, they're going to get your permission to log on to studentaid.gov and process these applications, consolidations. And many times, because these programs are somewhat confusing, they're not even very sure about the process, so it could end up being not the best for the borrowers in the long run. So we want to make sure that you understand you're not a victim of identity theft. You don't give away your FSA numbers, login information, everything. So this is for even non-borrowers are getting these calls, and somehow they are accessing borrowers correct information. So they will say, they'll know who your servicer is and how much you owe. So we want to be very, very careful. And if you do have any doubts, whether it's a legit company, you can always reach out to me. You can file a complaint through us, but Google will be your best friend. So know your servicer. Studentaid.gov is where your main portal for all these actions. So it's very important to know. And with that, I will hand it back to Samantha, I believe.
Thanks for those important tips, Selena. We all know that, unfortunately, especially during these times of new announcement and changes to programs, that is when scammers unfortunately come out well armed to reach out to folks. So please take those tips into consideration. Next, there is another lesser known type of student debt called institutional debt that we just wanted to raise some awareness with you all. You heard earlier from Assemblymember Pacheco mention this issue. And so unlike student loan debt, though, institutional debt is debt owed by students directly to a higher education institution that results in unpaid tuition, fees, or other financial obligations. And right now in California, colleges and universities are using harmful debt collection methods to collect on this debt, It can look like withholding a diploma once you've already left, college or your university, or banning students from re-enrolling in order to continue and complete their degree program. So if this sounds all too familiar to you and you want to learn more and share your story, please check out the coalition's website. Here on the slide, it's californiaborrowers.org. And with that, we will move on to the next portion of our webinar. Next slide. We are going to be trying to answer as many questions as we can today. So go ahead and please drop your questions in the Q&A box at the bottom of your screen. We'll try to get through as many as we can before we hit 2 p.m. And then also next slide, we want to keep this slide up while we are answering questions for folks tuning in, just so that you have some of those important links that were mentioned throughout today's webinar. And then just a friendly reminder, we will be, again, this is being recorded, and anyone who registered today will receive the recording and the slide deck. So we are trying to get as much information out to you as possible. All right. And with that, question for any of our panelists today. We are getting a lot of questions around the SAVE plan. So Brianna asked, is the SAVE plan a qualifying plan under the Public Service Loan Forgiveness Program?
Yeah, that's a great question. And the short answer is yes, it does. But before I dive into it, I just want to take a step back for audience members that maybe aren't familiar with this concept in the first place. There's this program, Public Service Loan Forgiveness, and the way that this works, if you work for a 501c3 nonprofit or a government entity, after 10 years of qualifying payments, you can have your remaining student loan debt forgiven because of your public service work. And the way a borrower really can maximize their benefit in this program is that if they have lower income, they enroll in one of these income-driven repayment plans that lowers their monthly payment. And that means by the end of the 10-year period, they have more chunk of student loan debt left over to be forgiven. So that can help them lower their monthly payment and also get this significant relief at the end of 10 years. So the SAVE plan is another one of those income-driven repayment plans that does qualify for progress made in public service loan forgiveness. So there's a lot of folks out there that, if you're just hearing about this today, you should enroll in one of these income-driven repayment plans to lower your payments, and then start investigating the application for public service loan forgiveness, so you can communicate to the Department of Education that you work for a qualifying employer.
Thanks, Cody. Couple more questions here regarding the SAVE program. Does a spouse's income need to be reported to apply for the SAVE program, or does it just take into consideration the borrower's income?
Yeah, so, and Selena, definitely feel free to jump in here, but under the SAVE plan, a couple's joint income will be used regardless of how they file their tax status. So in the past, a borrower who made low income, but as a married couple maybe had relatively high income, may choose to file their taxes separately from their spouse, so that their income-driven repayment plan was calculated using just their own individual income. That has become not really an option to folks who are enrolled in the revised pay-as-you-earn plan, the Repay It program. And this SAVE plan is replacing that. So it similarly does not allow for that option.
And then this one brings us to a little bit more about the IDR programs in general, but is there any penalty with switching kind of in between, in and out of the various IDR programs? And with the SAVE program, is that the only IDR program moving forward, or will the others be available still?
I can answer that. So the SAVE plan will replace only the repay plan at this point. So you still will have the IBR, ICR, and the standard plans, graduated standard plans. So it will be replacing the repay plan. And then as far as the first portion of your question, I believe that was about a capitalization, right? When switching IDR plan. So typically when a borrower switches from one IDR plan to another, there is capitalization that occurs. Under the new SAVE plan, that will not occur when, as of July 1st, unpaid interest won't be added to your principal when you leave any IDR plan except an income-based repayment, IBR, where capitalization is required by statute. So SAVE plan will not capitalize your interest, which basically means your loan balance will not increase as they typically do, which is what causes these balances to increase substantially when borrowers are making payment. It's not covered, or they're making payments and they're switching from one plan to another. This causes an increase. So under the SAVE plan, capitalization will not occur when switching to another plan.
Great. A lot of questions with this new program. So we'll try to get to some more. But I did see a couple of questions around Parent Plus loans. And so can parents with Parent Plus loans benefit from income-driven repayment plans and public service loan forgiveness or PSLF?
Yeah, that's a great question. And I know parents with Parent Plus loans often feel left out from the programs we talk about and the advocacy that's happening out there. Parent Plus loans can take advantage of one of the income-driven repayment plans that exist, and that is called income contingent repayment. The downside, and one of the reasons parents are very frustrated at times, is that this ICR, income contingent repayment, is the least generous of the income-driven repayment plans that exist. So the payment period to forgiveness is longer, and the monthly payments made under that plan are higher. Also, a Parent Plus loan that is eligible for the ICR plan has to be a Parent Plus loan that was consolidated into a direct or into a consolidated loan. Meaning if you have a Parent Plus loan that you have not consolidated before, you will need to do so to become eligible for an income contingent repayment plan. Similarly, a Parent Plus loan is eligible for public service loan forgiveness, but the same thing, you have to consolidate first to be eligible for that benefit as well.
Great, thanks, Cody. Another question on the SAVE program. Under this SAVE program, will the payments options still include a $0 payment plan? So I think, is that still possible under the SAVE program?
Yes, it's possible. It could be possible, and it all depends on the borrower's balance and their income. So these are income, and that's the same for all the income-based repayment plans, basically. So that's why it's really important to use the FSA, the loan simulator, so you can enter your information there, and you can look at your payment amount under each of the plans. So if your income is, if you are at a lower income, depending on in your balance, you may have a $0 payment, which, as long as you're enrolled in the plan, can still qualify you for the PSLF and IDR plan and IDR forgiveness. So it will still count as a payment, even if it's at a $0 payment amount.
Yeah, and if I could add quickly too, I think these formulas are really complicated and hard for the average person to really wrap their head around. But I had talked about earlier how the threshold for what is considered discretionary income has been heightened from 150% of the poverty level to 225%, which means if you make underneath that 225% of the poverty level, you have a $0 payment. So that means that many more people now will have a $0 payment because the threshold has been increased, meaning people that make more income, more people who make more income will be eligible for that $0 monthly payment. So we're going to see a lot of that in the months ahead.
Great. And then following up on the SAVE program again, and this one might be coming from those borrowers who just left college, just graduated. So they're coming into repayments for the first time. So Maria is asking, do you have to be working currently in order to qualify for the SAVE plan? It seems like if someone hasn't been working full time since maybe earlier this year, not sure if they qualify for the SAVE plan.
Yeah, that's a really good question and worth being really clear about. You do not have to be working to benefit from these programs. And in fact, I think those who benefit from these programs the most are those who have very low income or are not working. So if you have not worked before, or you currently have lost your job or have reduced hours, an income-driven repayment plan is great for you. And the one thing I wanted to add is you can recertify your income for these plans at any time. And so, for example, during the pandemic, we had a lot of people who were enrolled in an income-driven repayment plan, and that had lowered their monthly payments, who had work, and then they lost their job because of the pandemic. And they were able to contact their servicer right then and there and reduce their monthly payment even further, because now it was based on the fact that they had zero income when prior maybe they had a low-paying job. So you don't have to be working, and if you are working and you lose your job, you can use that as an opportunity to make your payments more affordable because of your circumstances.
Great. Thank you for clarifying for that. I think there's a little bit of confusion still around student debt cancellation. We had one question, given where it's at, that it's being blocked by the courts. So is there really any point in applying for debt cancellation? Which I'll start off maybe with a quick answer. There's, the application that was posted for the president's original plan that Cody explained, that is no longer going to be a viable option moving forward. But for our panelists here, maybe, what is kind of the next steps for borrowers regarding debt cancellation, or how they can get involved?
Well, I think being here today is a start, right, to really understanding that. So that plan is basically not, you can't benefit from that plan. It's no longer available. So you need to look at your loan, at your goal basically, and look at, are you a public service employee? Can you benefit from the public service loan forgiveness program? Are you a person that can benefit for income-driven forgiveness program, which is a longer-term program? So really focus on, getting set up and getting back on track for the following months when repayments start. So that program, until we hear something, which Cody mentioned at the beginning, is the rulemaking process. It's a long process right now. Really, the focus for borrowers should be, okay, let me get back on track with my repayment. Which plan is best for me based on my, if my goal, if I want to apply for forgiveness, these are the forgiveness plans available, which really, as I said, we keep saying, mentioning PSLF and income-driven forgiveness. So those are going to be your options. And one thing that I do want to mention, and I think it's really important, these COVID payment pause months do count towards public service loan forgiveness and towards income-driven forgiveness. So if anyone that's enrolled in PSLF and they were on the pause, don't think because you were not making payments and were on forbearance that those are not going to count. So you're getting over 3 years, 36 months, almost 40, over 40 months, I believe, of credit towards PSLF. So in reality, you have to certify and be on a payment, making a payment, even if it's $0 on an IDR plan, you only need about 7 years of payments. So, very important to keep that in mind, as well as with the IDR forgiveness. So really it's focusing on what options are available now, and asking questions, because it is confusing, we understand, but the 10,000, 20,000, even if you received an email, an official email from the Department of Education saying we've processed and approved, or we've approved your forgiveness, unfortunately, that's not happening.
I don't know, Cody, if you wanted to add anything real quick.
Yeah, I mean, I think I absolutely agree with Selena that in the absence of immediate relief right now, the best thing borrowers should do is become familiar with their rights and options. As an advocate, the one thing I would add is that the continued fight for debt cancellation and broader relief is in this rulemaking process. There are opportunities to share public comment at different periods. So, connect with groups like us at SDCC or others to essentially figure out how to use your voice to continue to move these reforms in the right direction. So those opportunities will be coming up periodically over the next year. And that's another way you can get involved.
Thank you both. And as we are getting near the end here, maybe we can answer one more question. I am going to ask that the next slide can be posted up. And some folks are asking in the Q&A as well, if there's contacts information, if folks would like help with further questions or further resources. So this slide right now in front of you has some of those links to where you can get further information and hopefully get some more of your questions answered. And again, we are collecting all these questions and we'll try to get back to as many folks after today as possible. So maybe last question, again, on the SAVE plan. Regarding the SAVE plan and the monthly payments, is the income threshold before or after taxes?
Yeah, so that's a great question. What is really important for these income-driven repayment plans is the adjusted gross income, and you can find that by essentially reviewing, a recent tax filing of yours. The good thing is that the Department of Education and the IRS have worked together over the last few years to do data sharing. So if you go online to apply for these programs, you'll be able to connect your IRS account with your Department of Education account. They will share the data and all the income information they have for you will be submitted directly there. But I should also add, there are people who do not file taxes. There are people, like I mentioned, that have more recent changes to their income. And so you can contact your loan servicer or you can even get the application online. And there are other ways to demonstrate your income as well. And then a third piece, just quickly, because of kind of the chaos that exists in the system right now, the Department of Education has instructed loan servicers to accept income information over the phone in what's called a verbal attestation. So if all of this is kind of confusing to you or you're concerned about being accurate, you can also call your servicer and they are supposed to, at least right now as a temporary measure, take income information over the phone without you having to provide like this documentation or proof.
Thanks for that, Cody. With that, I think we are at time now for what we have for today. Thank you all for attending today's webinar. We will be emailing today's recording as well as the slide deck to all who registered, and we're capturing all the questions in the chat box in case we didn't get to them today. Thank you to all of our panelists, Cody and Selena, and our technical assistant support behind the scenes, Kimberly and Andrea. Thank you again to Assemblymember Pacheco and her office for their partnership. We hope that the information shared today is helpful, and we'll be trying to follow up with you as well if there's further questions. So thanks everyone, and have a great rest of your day.
Thank you everyone for joining us.